Look around you. Look at the phone in your hand, the car you drive, the house that holds your family. Everything you own, everything you rely on is tied to a promise. A promise made in a glass tower on a trading floor on the other side of the world. Your money is not safe. Your stability is an illusion of distance. Today, we pull back the curtain on the great global connection. We see the threads that bind the world's economy together and expose the few opaque choke points where the entire structure can and will fail. The heart of the global financial system is controlled by a handful of institutions. They are not just banks, they are super intermediaries. They sit at the core of what experts call the core periphery structure. Think of them as massive, hyper-connected hubs, places like JP Morgan, Goldman Sachs, Deutsche Bank, HSBC. These institutions are linked to everyone. They are the main counterparties in trillions of dollars of derivatives. They fund the smaller peripheral banks. They clear the payments. A failed investment by a tiny regional bank? It's an isolated event, a catastrophic failure by one of these core players. It is, by definition, systemic collapse. 2008, the failure of Lehman Brothers. Why did that one event plunge the entire world into panic? Because Lehman wasn't just a bank, it was a node in the network. When it defaulted, it owed money to and was owed money by virtually every other major financial institution. The system wasn't afraid of Lehman failing. The system was terrified of the contagion, the domino effect. They couldn't even map the exposures. This risk hasn't gone away. It has simply migrated. It has grown. You are still paying the insurance premium for institutions that are structurally designed to transmit disease across the financial body. Where is the greatest point of failure? It lies in the shadows, in the opaque world of derivatives. These are contracts whose value is derived from something else, an interest rate, a commodity price, or someone's ability to pay their mortgage. The notional value of these contracts is estimated to be in the hundreds of trillions of dollars, many times the value of the entire global economy. It is a promise, built on a bet. And who is on the other side of these bets? Those same few core banks. When one bank fails, it is not just that bank's debt that matters. It is the cascading loss on these interwoven contracts. Regulators are supposed to track this, but the system is so complex, so many transactions are done over the counter, OTC, unreported, unstandardized, that even the people who designed the rules admit they are flying blind. They gave us transparency, but they let the complexity multiply the risk. The connections are invisible until the moment of rupture, and then it's already too late. Think about your pension fund, your retirement savings. They are not sitting in a vault. They are invested in assets, which are backed by derivatives, which are often insured by those very same core banks. The moment a shock hits the core, the money you plan to live on, your security, is caught in the chain reaction. Your future is collateral in their casino. But the formal banking system is only half the story. The really volatile, truly unhinged risks have been shoved into a dark corner, a place we call the shadow. The regulators tightened the rules on commercial banks after 2008, but capital, like water, always finds a crack in the dam. The dam is called regulation, and the crack is the shadow banking system. The shadow is any institution that performs banking-like functions, lending, borrowing, credit creation, but operates outside the traditional safety net. These entities are not subject to the same capital requirements. They don't have deposit insurance, and yet they are handling trillions of dollars, interlinked with the formal system through complex repo markets and funding lines. The core issue is a liquidity mismatch. The shadow banks take short-term, easily withdrawn funding and use it to buy long-term, hard-to-sell assets. They are borrowing short and lending long. This is called maturity transformation, the classic function of a bank. In calm times, this is profitable. In a crisis, if the lenders suddenly demand their money back, the shadow bank must sell its long-term assets immediately, driving the price down for everyone. This is a modern, high-speed bank run, and the contagion spreads through asset prices, not through a bank teller line. The risk is not contained, it bleeds into the regulated banks that lend to them. Look at March 2020. The COVID-19 panic wasn't caused by a financial failure, but it triggered on. Investors panicked and pulled money from funds. These funds had to sell US Treasury bonds just to raise cash. The Treasury market, the bedrock of global finance, almost froze. Why? Because the sheer scale of the shadow banks selling overwhelmed the market. The global system needed $1 trillion emergency intervention from the Federal Reserve to prevent a liquidity spiral. They told us they saved the system in 2008, but they only moved the risk to the less regulated, more volatile shadow, where it remains highly leveraged and waiting for the next panic. And how did they magnify this risk? Through hidden leverage. This multiplies the velocity of capital, but also multiplies the losses when the value of the original asset drops. They are building a house of cards on a trampoline. The threads of debt and risk are interwoven, but there's an even more fundamental connection. the currency that lubricates the entire machine. Every part of this global machine, from an oil tanker in Singapore to a bond deal in Frankfurt, is priced, financed, and settled in one currency, the US dollar. It is the world's reserve currency, and its unchallenged dominance is the single greatest point of global financial interdependence. This means that when the Federal Reserve in Washington, D.C. makes a decision about its interest rate, it is not just setting policy for America, it is setting the cost of capital for the entire world. Here is the terrifying flaw. There are trillions of dollars in debt outside of the United States, corporate debt, sovereign debt, that must be repaid in US dollars, but these entities, these countries, don't have access to the Fed's printing press. They rely on the global interbank market to get those dollars. When panic hits, everyone rushes for the door at once to grab dollars. The supply dries up. This is the offshore dollar funding gap, the system's central fault line. It's why a crisis in Europe or Asia becomes a dollar crisis, forcing borrowers to sell any asset they can, gold, stocks, local bonds, to get the currency they need. They sell good assets to pay for bad debts. Think about the emerging markets, developing nations with families and economies trying to climb out of poverty. They borrow dollars to build infrastructure. When the Fed raises rates, that loan becomes more expensive. Their currency collapses against the dollar, and their national debt spirals out of control. This understanding, this awareness of the hidden risks that control your life, is your best defense. Knowledge is power, and this is just the beginning. If you want to continue pulling back the curtain on the opaque powers that shape our world, if you want deep, urgent analysis on economics, geopolitics, and hidden history, you need to follow this channel. Don't wait for the next crisis to understand the system. Hit the like button, subscribe now, and turn on notifications